Thank you both for being here. Megan, I want to start with you because, Citi's saying 50%. The markets are actually pricing in a much lower percentage probability for a recession. Bank of America saying that the recent rally means that the markets are now pricing in a 20% probability of recession versus 36% probability that was priced in June. Do you think the market is overestimating or underestimating the risks right now?
Yeah, well, Leslie, I think it does matter which market you're looking at. I think the equity market is starting to increasingly price in that soft landing and discount the chance of a recession either this year or in 2023. The bond market, however, and the rates market specifically, you're still looking at a very deeply inverted yield curve, which historically, we all know what that means. It just takes time to play out. And I think equity investors might be a little bit less patient than bond investors here, but I think that the market might be getting a little bit ahead of itself in terms of pricing in that soft landing. It's still a possibility. It's still something that we actually think can happen, but there is a lot of wood to chop on inflation as we go into the end of the year.
Andrew, do you agree with that? And do you think that there's anything that the Fed can say, in today's minutes at 2 p.m. that would move the market either way, or is it, at this point kind of backward looking?
I think the market will be fine with inflation coming down. And as long as inflation is coming down, that will be good enough for equity support. But in terms of your recession, no recession, what I would point out is that in the first half of this year, when we had a very bad pullback, energy and defensive, which are late cycle stocks, they led. And consumer discretionary, which are early cycle stocks, was the worst decliner. Since the end of the second quarter, the worst performing sectors are energy and the defensives. And the best late cycle and the best performing stocks are consumer discretionary early cycle stocks. So I think the market is telling you it's less likely a recession is out there. So really a question of, are you smarter than the market? You think you're smarter than the market, or do you think you take the cues from the market? I think the market is sending a very powerful message here.
All right, well, it sent it last week. Of course, we were up on both those tamer than expected inflation reports, PPI and CPI, Andrew. But, a week does not make for a market prognostication. I mean, what are you seeing from here towards, let's call it the end of the year, given the scenario you just laid out?
Well, I think the market, since the beginning of the year, and I've told you this before, David, I think the market's going to end up where it started the year. It's going to be not a great year for equities versus the start because you have a battle. And the battle is the Fed, and the Fed is raising rates, is calling PE compression. But the call that earnings were going to collapse just hasn't come through. And so that's been better news than expected. I still go back, this reminds me of 2011, where very different macro story, but it was 2 years coming out of the previous recession. Earnings didn't collapse as much as the bears believe, and I think that's the battle. So I thought the rally would come more in the fourth quarter. It's come sooner than I thought, but I still think that, you're looking at a flattish market for the year, which is still pretty good upside from here, although I certainly can see the market is pretty overbought near term. I just think there's a lot of bears, too much cash on the sideline. I see it in our flows, people that have missed down the rally, and now there's a little bit of FOMO.
Shepard Smith here. Thanks for watching CNBC on YouTube.